Okay, so guys, now we shall go ahead and take on a bunch of examples on convertible bonds. You will learn this in Ind AS number 109 as something called compound financial instruments. Ind AS, Ind AS 32/109 on financial instruments, right?
Yes, sir.
So these are compound financial instruments where the bondholders are given an option to buy equity shares in your company, in a company. Because throughout the chapter, you will be the bondholder, I am the bond issuer, right?
Yes.
So you have an option to buy shares in the company. Now let us go ahead and take on this example, question number 22 from your handout. Yes.
The following data is related to 8.5% fully convertible into equity share debentures issued by JAC Limited at rupees 1000.
Okay.
The market price of debenture is 900 rupee. Conversion ratio is 30. Straight value of debenture is 700 rupees. Market price of equity share on the date of conversion 25 rupees. Expected dividend per share rupee 1. You are required to calculate A. Conversion value of debenture.
Now listen, let's take up each question.
Okay.
We'll discuss and see the answer. Is that fine?
Yes, sir.
Now they're given the data regarding the convertible bond. It is given that these bonds are issued at rupees how much?
1,000.
At rupees 1000 face value, right?
Yes, sir.
It's given that these bonds are currently trading in the market for rupees 900. In case you were to buy this bond in the market, you have to pay rupees 900 to someone who's going to sell the bond. And also is given something called the bonds straight value. Let's understand that later. And it's something called the conversion ratio. What is that? Every bond, suppose you're holding one bond, one of these bonds, you can convert the bonds into how many shares?
30.
Into 30 shares, right?
Conversion ratio.
Every bond will convert into 30 shares. That means what? A person holding one bond has an option to buy 30 shares in the company. Got it?
Yes, sir.
He is also given the market price of one share and also the dividends expected on the share. And what is the rate of interest or coupon on these bonds? 8.5%. And you always calculate the percentage interest on the face value. You calculate the coupon, right? 8.5% on rupees 1000 face value. Rupees 85 will be the coupon income. Now let's answer the question one by one. What is the first question asked?
Yes, sir. Conversion value of debenture.
Very simple. This conversion value is also known as something called the STOCK value, stock value of the bond. I repeat, conversion value of the bond is also known as what?
Stock.
The stock or the share value of the bond. Very simple. Every bond will give you the right to buy how many shares?
30.
30 shares. That is the conversion ratio you take. And every share is currently trading for how much in the market? 25 rupees. Multiply. That's it. 30 shares into rupees 25 per share. How much you get?
750.
That is supposed to be the conversion value, or I can say that is supposed to be the stock value of the bond. Is that fine?
Yes, sir.
So 750 rupees. Just see the formula out there.
Market price of one equity share into conversion ratio.
That is all. Take rupees 25 per share, that into 30 shares. Or you take 30 shares into 25, doesn't matter, right?
Yes.
It is 750 rupees is a conversion value or stock value of the bond. That is answer to the first subdivision. Second
question is market conversion price.
Very simple. This market conversion price is nothing but, now tell me Renuka, suppose you want to first buy the bond and then exercise your option to, instead of buying shares in the company directly, right?
Yes, sir.
You want to buy the bond and turn them into shares. So what is the price you pay for the bond? 900. And every bond will turn into how many shares? 30 shares. Now what is rupees 900 divided by 30 shares?
It is 30 rupees.
Rupees 30 is called the market conversion price, also known as the conversion parity price. I'll tell the reason later. Is that fine?
Yes, sir.
It is called the conversion parity, not disparity. What is that?
Parity.
Means sameness, right? So conversion parity price. So the market conversion price, just see the formula. Take the market price of a convertible bond, numerator, how much? 900, divided by the conversion ratio,
30.
which is 30 shares. So rupees 30 per share is called the market conversion price. Understood?
Yes, sir.
Next.
C. Conversion premium per share.
Very simple. Now tell me, Renuka, had you bought shares in the market directly in this company, you would have paid how much? Only
5
rupees, right? But what I mean, suppose you buy the bond for 900 and then turn them into 30 shares. What is the effective price you are paying per share? 30 rupees. Therefore, please remember the market conversion premium, which can be expressed in rupees per share and also can be found as a percentage. Both you can do, right?
Yes, sir.
Just say the market conversion premium per share equals nothing but take the market conversion price, also known as a conversion parity price, which is rupees 30 minus 25. That means you are paying 5 rupees extra on every share effectively. Yes or no? 5 rupees extra. This extra 5 you are paying over 25 rupee can also be expressed as a percentage. Let's see the next one.
Yes, sir.
Ratio of conversion
D question
premium.
is ratio of conversion premium.
What is that? Nothing but they're dividing
Conversion
5
premium
rupees.
per share divided by market price of the
That's
equity
all.
share.
You are paying 5 rupees extra over 25 rupees, right?
Yes, sir.
So 5 by 25 into 100. How much? 20%.
20%.
That's it. Now go back to the question
Yes, sir.
asked.
Question number E. Premium over straight value of debenture.
So when asked to calculate the premium over the straight
Value of debenture.
value of the debenture. Very, very simple. Nothing but we know straight value of the bond is how much? 700.
700.
What is the meaning of straight value? Let's understand. Straight value is nothing but the present value of all the bond cash flows on the assumption that the bond holders will not exercise their option to convert the bonds into shares. That means what? At the time of redemption, the bond holders will get cash instead of getting shares. Got it?
Yes.
If that is the case, remember it's only an option given to bondholders, right?
Yes.
Suppose a bondholders decide, you people decide not to get shares in the company. That means not to convert the bonds into equity shares. What is the present value of all the bond cash flows, including the redemption value? That is supposed to be the straight value of the bond. That is supposed to be the straight value of the bond, which is rupees how much? Which is rupees 700. Okay. That is our bonds straight value is rupees 700. Got it?
Yes, sir.
I repeat, straight value of the bond is nothing but the present value of all the bond cash flows discounted, okay? Discounted at a rate applicable for a non-convertible bond. Is that fine?
Yes, sir.
That is discounting all the bond cash flows using the yield applicable for a non-convertible bond. That is straight value of the bond. Okay? How much? 700.
100.
And there is a sum later where you are supposed to find the straight
Value.
They will give the discounted applicable for a non-convertible bond. Okay?
Yes, sir.
That is 700. And we know currently these bonds are trading at how much? 900. Yes or no?
Yes, sir.
So, 900 rupees a bond current market price. It can go down. In case you decide not to convert, the bond is worth how much? 700. It can't go below that. So, 900 can come down to how much? 700. Now, how to find the premium over straight value? Very simple. 900 divided by
700.
700 minus 1 into 100. How much you get?
28.6%.
Either you can do this or what are you going to do, Renuka and others people watching the video? You can take 900 minus how much?
700.
700. How much? 200 extra. 200 by 700 into 100. Find the percentage.
It is 20.
You will get 28 points. Same.
6%.
28.6. 6% will be your premium over state value, which is also known as, please make a note, is called the downside risk of a bond. What is that? Downside risk, because the bond worth cannot go below how much?
700.
So because in case, let us say, for example, Renuka, let's say the company shares after redemption.
Yes, sir.
Suppose the company shares are trading at, let's say the company trading at rupees 20.
Yes.
Now what is 30 into 20?
It's
600.
600.
You go for 700, right? You will not convert the bonds into shares.
Yes.
Please remember, in case that is 700 is supposed to be the floor value. The bond value cannot go below how much? 700. It's worth. Understood? In present value terms. Got it?
Yes, sir.
So that is why this premium over state value of a bond is also known as what? The downside risk of a bond. And the last subdivision, two more.
So, a favorable income differential per share.
Very interesting computation. Check this, okay? Let us say Renuka bought the bond in this company. Now, how much interest will you pocket every year? 8.5% on face value 1000 rupees. 85 is a coupon income, right?
Yes, sir.
Suppose you bought, let us say instead of buying this bond, you bought 30 shares in the company. Instead of buying one bond, okay, and later converting them into 30 shares. Suppose you bought 30 shares in the market. And what is the dividend expected per share? 1 rupee. What is 30 shares into 1 rupee?
30 rupees.
Only 30 rupees will pocket, right? Dividends. But how much are you earning in coupon? 85 rupees. You're earning how much extra?
55.
You're getting 55 rupees extra on these bonds as coupon. And still you have an option to buy how many shares? 30 shares, right?
Shares, yeah.
Now, what is a favorable income differential? Nothing but take the coupon income on the bond minus the dividends you would have earned had you bought the 30 shares. So conversion ratio into dividend per share divided by 30 shares. Yes or no?
Yes, sir.
Because one bond you're holding, you can convert them into 30 shares anyway. So you're earning 55 rupees extra as coupon, and still you have an option to convert the bonds into 30 shares. What is a favorable income differential per share? 55 rupees by 30 shares, how much you get? 1 point. Rupees or 1.833 per share. Now you understand that is why Renuka and you people, you were okay to pay how much extra for every share? Remember, 5 rupees premium, market conversion premium. Yes. That is why, because you know the bond pays the more income than what? Than the shares currently. Got it?
Yes, sir.
So 1.833. Now last question, find the premium.
Payback period.
Very simple. The 5 rupees what you paid extra, right? For every share, effectively.
Yeah.
And you want to earn how much extra from the bond? 1.833, right?
Yes.
In how many years it recover this money? 5 rupees
years.
by 1.833.
2.73 years.
That is all. In 2.73 73 years, you will recover the extra money what you paid, and then if you want, you can convert the bond, right, into shares. That's called the premium payback period. Got it?
Yes, sir.
So these are the possible questions on convertible bond. I repeat, what is the first one? Conversion value, right? Point A. Also known as what? Stock value of the bond. And number 2?
Market conversion price.
Conversion price. And number 3?
Conversion premium per share.
And then number 4?
Ratio of conversion premium.
Nothing but that's a percentage. Next, number 5?
Premium over straight value of debenture.
Nothing but the downside risk of a bond. Next?
Favorable income differential.
And last, a premium payback. Is that fine? Guys, pause the recording and jot down the solution. Very important. Please write down the formula and then plug in the numbers. Is that fine?
Yes, sir.
Just pause the recording. Now let us go ahead and take on the 19th question from the handout. In this example, you are supposed to find the straight value of the bond, which I said in the earlier example as well. It is a present value of all the bond cash flows on the assumption that the bond is a non-convertible bond, right?
Yes, sir.
Now let's go ahead and take on this question, Esma.
So GHI Limited, a AAA rated company, has issued fully convertible bonds on the following terms a year ago. Face value of the bond 1000 rupee, coupon interest rate 8.5%, time to maturity remaining 3 years, interest payment annual at the end of the year, principal repayment at the end of bond maturity, conversion ratio number of shares per bond is 25, current market price per share 45 rupees, market price of convertible bond 1175 rupees.
Okay.
Should I read further?
Read.
AAA rated company can issue plain vanilla bonds without conversion option at an interest rate of 9.5%.
Point to note, I will take 9% for discounting all the bond cash flows to find the straight value of the bond.
9.5%.
9.5%. And that is nothing but, remember, the straight value of the bond, also known as what? A plain vanilla bond, where the bond does not have additional features. Example, conversion of bonds into shares. Next.
Required, calculate as of today, number 1, straight value of the bond, number 2, conversion value of the bond, number 3, conversion premium of the bond, number 4, conversion premium, 4% of downside risk, and 5, conversion parity price.
So
Given the present value factor for 9.5% for year 1, 2 and 3.
How nice. They given the discount factors at 9.5% in the question itself, right?
Yes, sir.
Now the first question, let's find the straight value of the bond. Nothing but the value of this bond had it been a plain vanilla bond without any conversion feature, right?
Yes, sir.
Now how to go about? Very simple. It is given another 3 years to go for the bond, right?
Yes, sir.
As a bond holder, you will pocket rupees 85 coupon every year. 8.5% is a coupon rate. On face value rupees 1000 is rupees 85 each year. So you will pocket rupees 85, another 85 in year 2, and then 1085 in year 3, including the redemption value, right?
Yes.
In case you decide not to convert the bonds into shares, you will pocket rupees 1000 in cash. Now calculate the present value of all these numbers at a 9.5% discount rate. That is a rate applicable to a bond having no conversion option. Got it?
Yes, sir.
Now just see the calculation. Rupees 85 into
9132
plus 85 rupees into
0.8340
plus 1085 into
0.7617
add up all the three, you get 974.96
96.
or say 975 if you want to in the examination, no problem.
Yes, sir.
And that is supposed to be the straight value of the bond. Number 2, you have been asked to find the conversion value. Very simple. From the previous example, conversion ratio into the market price per share. Now tell me, what is the market price per share?
It is 25 rupees.
It is 25 rupees. And
No,
what is
45 rupees.
45, okay, 45 rupees, guys. And what is the conversion
That
ratio?
is 25 shares.
25 shares. So 25 shares into rupees 45 per share works out to rupees
120.
125 is called the conversion value, also known as a stock value of the bond. Is that fine?
Yes, sir.
And the third question asked.
Conversion premium.
Remember, we know conversion premium is nothing but you can find on per share basis. Also, you can find the percentage, right?
Yes, sir.
So, what is the formula for market, the conversion premium per share? You take the market conversion price of a bond minus a market price per equity share. So how to find the market conversion price? Very simple. The bonds are currently trading at 1,175 rupees and divide that by the conversion ratio, which is 25 shares. So what is 1175 by 25 shares? You get 47 rupees. You get 47 as your market conversion price minus a price per share is 45 rupees. So what is the premium per share? 2 rupees extra. You can express this 2 as a percentage also. And don't see the alternative solution, guys.
Yes, sir.
You stop at 47 minus 45, 2 rupees, that will do. Don't see the alternative solution given out there.
Yes, sir.
Then in case you want to find the ratio of conversion premium, you know the formula. Take the conversion premium per share, what you got, 2 rupees, divided by 45 rupees market price per equity share into 100. Works out to 4.44%. That's it. And that is a market, that is a ratio of market conversion premium. Got it?
Yes, sir.
And the next question, find the
percentage of downside risk.
Very simple. Either you can take 1175, which is the price of the bond now, divided by the straight value 974.96 minus 1 into 100. Or what are you going to do? What he has done? 1175 minus 974.96 upon 974.96 into 100. How much you get?
20.52%.
And please don't bother about the alternative, that's wrong. He has given dividing the difference by 1175 is not the right answer.
Yes.
Okay, that is wrong. Straight away, if you write that answer in the examination, the exam will draw an X through the answer. That means you are wrong. Always remember, you calculate the downside risk or the premium over straight value as a difference by the straight value into 100. Understood?
Yes, sir.
And then next,
conversion parity price.
very simple, also known as the market conversion price. Very simple. Divide 1175 by 25 shares, 47 rupees. Why is it called conversion? No, it's called the conversion parity price. I will tell you. It is called parity price because suppose, let's say the shares are trading in the market at, right now what is trading at? 45 rupees, right? Suppose it goes to 47 rupees a share. It doesn't matter whether you buy the shares in the market
or bond,
or buy the bond and convert them into what? 25 shares. It doesn't matter. Both will be what? 47. Right now it is 47 rupees effective price and 45 no market price.
Yes, sir.
Suppose the price of one share goes to 47. It doesn't matter whether you buy the share in the market for 47 or buy a bond and convert them into shares. It will be 47 rupees per share. Got it?
Yes, sir.
That is what it's called the market. It's called the conversion parity price. Nothing but the market conversion price. Is that clear?
Yes, sir.
So guys, I'll pause the recording and jot down the solution.
Yes, sir.
Okay, now we shall go ahead and take on question number 13 from the handout. Yes.
Yes, sir. The data given below relates to a convertible bond. Face value 250 rupees, coupon rate 12%, number of shares per bond 20, market price of a share is rupees 12, straight value of the bond 235 rupees, market price of the convertible bond 265 rupees. Calculate number 1 stock value of the bond, number 2 percentage of downside risk, number 3 conversion premium, and number 4 conversion parity price of the stock.
Now please refer to the solution out there. Now first question is calculate the conversion or stock value of the bond, right?
Yes, sir.
Nothing but you take the conversion ratio, which is 20 shares. That is, every bond can be converted into 20 shares.
Yes, sir.
And the shares are trading at rupees 12 in the market.
Yes, sir.
Now what is rupees 12 into 20?
240.
240 is called the stock or the conversion value of the bond. First question answered.
Yes, sir.
Number 2, you've been asked to find the
Percentage of downside risk.
very simple. Again, follow only one solution out here. It should be 265 minus straight value given 235 divided by 235 into 100.
12.77%.
Or what are you going to do? 265 numerator divided by 235, you get
Minus
one factor.
1 into-
Minus 1 into 100. It's up to you. You get the same number, right?
Yes, sir.
And don't see the alternative answer. That's wrong.
Hmm.
Number 3, I've been asked to find the conversion premium. You know the formula. That's why we didn't write the formula out there.
Yes,
Okay,
sir.
you find only the numbers. Remember, conversion premium per share is nothing but the market conversion price minus the market price of one equity share. What is the market conversion price? 265, the
right.
price of a bond, divided by 20 shares, conversion ratio. So 13.25 minus rupees 12 is rupees 1.25 per share is a conversion premium on a per share basis. But always find even the percentage even though it is not asked for. So 1.25 divided by the conversion premium will be divided by market price of one equity share rupees 12 into 100. You get 10.42%.
42%.
Is that fine?
Yes, sir.
Follow this solution, guys, and don't follow the printed solution out there.
Yeah.
And for the last subdivision, the same as the previous exam, find the conversion
Parity
parity
price.
price, also known as the market conversion price. It's all the same. Divide 265, the price of the bond, divide that by the conversion ratio,
Ratio
20 shares, rupees 13.25.
25.
Now, why is it called the conversion parity price? Suppose the shares, right now what? The market conversion price is 13.25. The shares are trading at 12. Suppose the share price goes up to 13.25 in the market. It doesn't matter whether you buy the share at 13.25 or buy the bond and turn them into shares. Is that clear?
Yes, sir.
So that is all, guys. Please go ahead and jot down the solution.
Yes, sir.